In the high-stakes theater of global finance, innovation is often lauded as the ultimate currency. Companies that promise to revolutionize traditional systems are hailed as visionaries, destined for unimaginable growth. But what happens when the very foundation of such a titan is not built on groundbreaking technology or robust financial models, but on an elaborate, audacious illusion? This is the story of Wirecard, a company once celebrated as Europe's answer to Silicon Valley, whose meteoric rise disguised a gaping $2 billion phantom ledger. For years, Wirecard AG embodied the dream of European fintech. Based in Munich, this German payment processor was lauded as a technological marvel, an unstoppable force challenging the old guard of banking. Its market valuation soared, its influence expanded globally, and its name became synonymous with digital payment innovation. Investors poured billions into what appeared to be an unassailable fortress of financial technology. Yet, beneath this shimmering facade of success and cutting-edge digital streams, its entire foundation was in essence written in invisible ink. The projected profits, the staggering growth, it was all a sophisticated phantom, waiting for the light to expose its true transparent nature. Wirecard's ascent was nothing short of spectacular. From a relatively obscure payment processor in the early 2000s, it aggressively expanded its operations, becoming an indispensable intermediary for online transactions across the globe. Their strategic positioning focused heavily on high-risk online industries, sectors like online gambling and pornography, which traditional banks often shied away from due to regulatory complexities and compliance burdens. This niche allowed Wirecard to capture significant market share and report seemingly staggering revenue growth year after year. The numbers on paper were phenomenal, a trajectory that saw its stock price outstrip even major German banks, reaching a market capitalization of over €24 billion at its peak. Data streams visualizing their reported revenue showed a near-vertical climb, a clear indicator, or so it seemed, of unprecedented success and operational efficiency. The company appeared to be an unstoppable force, a testament to German innovation and financial prowess. The genius and ultimate downfall of Wirecard lay in its sophisticated art of obfuscation. To achieve its staggering reported revenue, the company strategically employed a complex web of third-party acquirers, or TPAs. These were seemingly independent partners, primarily located in Asia, through which Wirecard claimed to process payments for its high-risk clients. The vast majority of Wirecard's reported sales and profits didn't come from its direct operations, but purportedly flowed through these TPAs. Our isometric data streams visualize this intricate dance, legitimate-looking profits being routed from Wirecard, not directly to its balance sheet, but through these opaque third parties, ultimately vanishing into obscure bank accounts, often in the Philippines or Singapore. The tactical decisions behind this were deliberate. These offshore entities allowed Wirecard to create the illusion of booming international business, while simultaneously making it incredibly difficult for auditors to verify the underlying transactions. To further deceive top-tier auditors like EY, Wirecard went to extraordinary lengths, fabricating escrow accounts that supposedly held billions of euros, and forging documentation to support these phantom balances. Bank statements were digitally altered, spreadsheets manipulated, and even confirmations from supposed trustee banks were manufactured. It was an elaborate stage play, designed to withstand scrutiny, creating an almost impenetrable financial fog around its operations. The billions in its phantom ledger were not merely missing, they never existed, they were conjured into existence by a masterful, almost theatrical deception. Despite the masterful obfuscation, the illusion could not last forever. The critical turning points in Wirecard's unraveling were spearheaded not by regulators, but by relentless investigative journalism. For years, the Financial Times, through its tenacious reporting, published a series of articles highlighting accounting irregularities, questionable business practices, and outright fraud allegations concerning Wirecard's Asian operations. Initially, Wirecard vehemently denied these claims, dismissing them as market manipulation by short sellers and even suing the newspaper. But the pressure mounted, As the fort continued to expose more details, including specific documents and internal whistleblowers, the sheer weight of evidence became undeniable. This relentless scrutiny finally forced regulators to act, and compelled Wirecard to commission an independent audit by KPMG. The internal panic within the company became palpable. The very data manipulation that had fueled its rise was now being challenged piece by piece, under a spotlight it could no longer escape. The sophisticated digital illusion was beginning to pixelate, revealing the void beneath. The end came swiftly and dramatically. In June 2020, KPMG's special audit failed to verify Wirecard's cash balances, citing a lack of documentation. The German financial regulator BaFin finally initiated an official probe. Within days, the catastrophic admission arrived. 1.9 billion euros, previously reported as held in escrow accounts in the Philippines, simply did not exist. It was a phantom, an illusion sustained for years. The news sent shockwaves through global markets. Wirecard's stock price collapsed, wiping out billions in shareholder value almost overnight. The company, once a symbol of German innovation, was forced to declare insolvency, becoming the first DAX 30 company to do so. Its CEO, Markus Braun, was arrested on suspicion of market manipulation and accounting fraud, and other executives soon followed. The plummeting metallic night perfectly illustrates the instantaneous collapse, the brutal reckoning for years of deceit. The Wirecard scandal is a chilling testament to the dangers of blindly trusting complex algorithms and the catastrophic failure of regulatory oversight when confronted with sophisticated digital illusions. It serves as a stark reminder that even in an era of advanced technology, basic accounting principles and diligent verification remain paramount. The profound absurdity that a multi-billion-dollar, publicly traded financial institution could sustain its empire by simply inventing money in bank accounts that nobody bothered to properly check exposes a critical vulnerability in our global financial system. It asks us to question how many other phantom ledgers might still be hidden within the digital intricacies of modern finance. Join us next time on the Boardroom Gambit as we deconstruct another high-stakes play in the world of corporate strategy. If this analysis of Wirecard's phantom ledger resonated with you, be sure to like this video, share it with your colleagues and friends, and subscribe to the Boardroom Gambit for more strategic insights into the plays that shape our world.